Thank you, and thank you, Ben. That was great. I actually I had some questions myself in the chat, so thank you for that. Definitely valuable. I will go ahead and share my screen as well. Okay, you guys tracking? First of all, thank you for having me. My name is Jake. Oh, not quite. And how about now? Excellent. Thank you, guys. So my name is Jake. Last name is Scarbo. Very nice to meet you guys. Thanks for having me. We'll kind of start off just telling you a little bit about my personal background. So I grew up here in the Kansas City area. I grew up in Blue Springs. Graduated, went up to Northwest Missouri State. I did go up for football. I have a two-time Division II football championship. So that's kind of my claim to fame. That was 2009 and 13. Graduated, ended up landing in Lee Summit. I am a husband and now father of two. I have a 4-year-old and a 1-year-old. So certainly in the thick of it right now. We are huge Chiefs fans. We have season tickets out there. We host a tailgate actually every time at Arrowhead. We call it, we've randomly branded it Tailgate for the Cure. We actually raise a lot of funds throughout the year at the tailgate, ultimately donating to St. Jude's and Hope Kids, which is another charity here in Kansas City. I am also a board member out at Whiteman Air Force Base. I built a large part of my career around serving those who have served our country. So a little bit of the professional background. Professionally, when I got out of college, I had a tough time finding a job for whatever reason. I was applying, interviewing, not really getting anywhere. So I actually landed with a temp agency. This temp agency was like, hey, we're going to send you over to this bank for 90 days. Let us know how you like it. And that was nearly 10 years ago. So I started as a mortgage loan processing assistant on kind of that 90-day contract. After that was up, they did hire me full-time to be a mortgage loan processor. Did that for a couple of years, and then I had the opportunity to be an operations manager after that. Did that for almost 3 years or so before I kind of found myself in a position professionally where I wanted to work with people one-on-one and do the loan consultant stuff. I love working with people, love talking, love being a part of this type of transaction. You'll see a little bit later, probably just through the presentation, but I absolutely love what I do for a living. If I can help someone buy their first home or their dream home, refinancing is a whole nother piece to this. We do a lot of debt consolidation stuff that really just impacts people's lives financially. I absolutely love this stuff. So I did the loan consultant stuff for about 3 years. And then was afforded the opportunity to lead the mortgage division and took a VP role. Now this was when rates were starting to actually skyrocket and go through the roof. A lot of banks were in a kind of a hot spot. Rates were going up very, very aggressively. Ultimately, that previous employer of mine ended up shutting down the entire division. So that put me in a spot where, I kind of went back to what I love, and that's working with people one-on-one. Again, here we are now. That is September 2023 through current. I'm now at Academy Bank. So enough about me. Here's what we're going to talk about today. So I'm going to bring you through kind of a discussion about equity. So equity is a term, we'll define it for you, but it is the number one reason, at least financially and from a wealth perspective, that people purchase homes. We'll talk about the barrier of entry to home ownership. There is a fact versus fiction slide in here that is probably the most frequently ask question type stuff. There's a lot of misinformation out there, so we're going to clean up a couple of those thoughts. I'll bring you through some loan products as well, some minimum down payment requirements, some minimum credit score requirements as well. There's some free credit score resources I'll share with you guys. We'll go through like a high level of the home buying process. And then my favorite part of this is actually very last. I will show you just exactly how to choose the right mortgage for yourself. So equity, to kick us off. So equity, if you don't already know what that is, equity is the difference between how much your house is worth, the asset, how much your house is worth, and how much you still owe on the mortgage. When is the best time to buy? The best time to buy is always now. You may think I'm crazy, but the truth is that there's two main reasons why the best time to purchase a home is now, and that's equity. And the reason is because of value appreciation out here in the market. Home values are going up and up and up very, very aggressively, and they have historically, year over year over year. Right now, especially with the lack of inventory, the home values are appreciating in value very aggressively right now. And then, of course, simultaneously, as you have a mortgage, you're making payments every single month, and so the balance of the mortgage is going down, simultaneously with the value of your property going up, ultimately helping you build that equity and contributing to your net worth. Here's a very compelling graphic. I pulled this from the Federal Reserve's website. They call it the Survey of Consumer Finances. It goes back to 1989. It's only through 2022, but I think this is probably getting the picture across pretty well. What this is it's giving a visual of the wealth gap between those who are renting and those who are owning. These are in thousands of dollars. So, 89, there's about a $200,000 difference. You zoom all the way out here, most recent, 2022, it's up to nearly $400,000 in difference in wealth between those who are renting and those who are owning. And then, of course, again, because of the last few years, property values increasing, equity positions increasing as well. This chart is probably even more compelling here in 2025 relative to what it's shown here in 2022. So this is definitely, a visual to help kind of double down on the value that having home equity brings. This is a good one pager. I printed this off. This is real-time data. There's a lot going on here, but I'll talk you through the main reason that I included this on the slide. So first and foremost, all of this information ties back to three sources. This is the Mortgage Bankers Association, or the MBA, the National Association of Realtors, or the NAR, and then Case Shiller, that's just another data source that we in the industry use. So the reason that I like this, and there's some good information about median household income. This is all relative to Kansas City, Missouri specifically. The median home price in Kansas City is $292. So I actually ran this example just at $295 for a nice clean number. So this is showing you demographics by age, number of homeowners versus renters. You got household income here. So all good data. But the reason that I use this is because it gives a historical and a forecasted view into that home appreciation. And again, that home appreciation, that's just the natural value that these properties are increasing. So over the last 5 years, very, very crazy stat, but homes have been appreciating annually, on average per year, at an 8% clip. Now, things have calmed down a little bit. The forecasted appreciation is a little bit less than that, but it's still at 3.01% on average per year. It's probably a little bit hard to see, but the reason that I'm showing you guys this is, again, to kind of double down on the value of having a home and building that equity, ultimately contributing to your long-term wealth. Here's why it matters. This little example down here at the bottom, if you start with a home value of $295,000, if that value is $295,000 today, then in 12 months, it's going to increase in value by 3.01%, making your home value next year $303 and change, almost $304. That is a $9,000 increase in your property's value over the course of just 12 months. Remember, simultaneously, you're making payments on your mortgage every single month, and so the value is going down. The value of your mortgage balance, is going down, while the property value itself is going up. Sorry, this is stuff that I love. I get nerded out with some of this. Hopefully you guys find that compelling. So here's some barrier of entry. I took a fact versus fiction type of thought process as I put this one together. I do still hear today very frequently that I need 20% to put down in order to buy a home. The fact is that that's not true. There are all kinds of loan programs. I'm going to show you several of them here in just a minute. You don't need 20% to put down. The other thing that I hear all the time is that, well, I know that I don't need 20%, but I really need 20% actually because mortgage insurance is so bad. That is also false. That is fiction. Mortgage insurance is not bad. Mortgage insurance is a tool that will help you get into home ownership earlier than you otherwise would if you sit around and collect that 20% just to dodge mortgage insurance. The other one here, my credit score is 580, so there's no way I would qualify. That is also fiction. We have loan options that go down all the way to 580. I have too much student loans. There's no way I would qualify. I owe way too much to the Department of Education. Also false. There are calculations in mortgage world that we use for, each respective loan product has their own kind of guidance on student loans, all of which boil down to a monthly payment that is typically advantageous to mortgage applicants in an effort to not exclude them from home ownership just because they have this student loan balance. The next one is, once I save for a down payment, I can buy a house. That is also false. And the reason is, and the number one sticker shock when I talk to first-time home buyers is the fact that closing costs go on top of your down payment. So not only do you have to come up with your down payment, depending on which loan you do, but there are also closing costs on top of that. We'll talk about that in just a minute. Now, the one fact here, it does take courage, guys, to open just a line of communication with a mortgage professional. It's scary, it's finances, you may not know really anything, but that's exactly what we're here for. It takes courage to kind of open that line of communication to really just kind of see where things stand, and that's always the first step. So let's talk about breaking down the barrier of entry. So when I was talking about having to come up with down payment and closing costs, that's pretty daunting. But it's not necessarily, a daunting task. So first and foremost, there are 0% down payment loan options available. Again, I'll show you a couple of those here in just a minute. And then as far as taking care of closing costs, there are also other levers that we can pull that will help cover those closing costs for you. One example would be seller concessions, is what we call. So if you go in and you make an offer on a home, it's a negotiation, right? And so one thing that we can do is we can ask the seller to cover your closing costs for you. Now, you don't have to worry about those closing costs. So the idea of concessions is a very, very common and good tool to use to keep that out-of-pocket expense at the closing table at a minimum. A realtor can also contribute concessions that can cover your closing costs, and even a lender can contribute concessions that would cover your closing costs. Other common tools would be a gift from a family member. You do see that quite a bit. And then other payment related strategies that are becoming more popular just because of the barrier of entry and rates and prices and stuff is what we call house hacking. So imagine if you went and bought a 2-unit property, you lived in one, rented out the other side, and used that money from the rent to actually help contribute to the mortgage every single month. It's called house hacking. And then there's also what's called a 2-1 buy down. Basically, you go and you negotiate the seller of the property to basically pay for the mortgage interest for 2 years up front for you. So if a interest rate today was 6.5, we would go and negotiate that the seller would pay the mortgage interest for you for the first 2 years, which means you would have a 4.5% interest rate year one, a 5.5% interest rate year 2, and then on year 3, you're up to your actual interest rate at 6.5%, and through the rest of the loan term, and that's all without the thought of being able to refinance in those first 2 years. So while the barrier of entry may seem high, there are certain things that we can do to make it more comfortable, especially from a down payment and closing cost standpoint. Loan products. There are yellow and blue highlights here. On the left, we have some pretty common home loan products that really everyone is going to have. And then we have on the right some specialty loan products that apply to Academy Bank. What I've done here is I've taken an approach to help you guys see just visually what these down payment requirements are going to look like. A lot of people hear first-time home buyer program. A lot of people hear, hey, I'm a first-time buyer. What does that do for me? The answer is typically within the down payment. So conventional first-time home buyers can put as little as 3% down. It does have a 620 minimum on the credit score. FHA is a government-backed loan. Also very common for first-time buyers, as little as 3.5% down. VA, this is for the folks that have served our country, military veterans, no down payment required on a VA loan, and they can go down as low as 580 on the credit score. USDA, also 0% down, 620 minimum credit score. USDA is going to be more geographically dependent. USDA is going to be in more of like the rural areas. MHDC is another one. This is a Missouri Housing Development Commission loan that basically provides a grant to help you cover the down payment. So effectively 0% down. That one has a 640 minimum credit score. And then some products that apply to Academy Bank is we do have a first responders loan here. So if you guys know any potential home buyers that are first responders, I'm talking law enforcement, firefighters, EMTs, nurses apply to this. We have a first responder loan here that can help people purchase a home with 0% down. That one has a 680 minimum credit score. A Premier Choice loan that we have is little as 0% down as well. Those in the audience may be familiar with what's called a doctor's loan, but basically this is geared towards a slew of different occupations, from doctors to attorneys to partner level CPAs to dentists. There's a slew of occupations that would apply that this Premier Choice is designed to help. As little as 0% down. This one is a 720 minimum credit score. Hero loan, nurses, educators. This one is 0% down, 580. I'm rolling through a lot of this stuff and really just trying to get across to you guys that the barrier of entry may not be as crazy as you think. It certainly, as you can see, 20% down is not required unless you're buying a second home here. That's a 720 minimum credit score. But my goal here with the loan product slide is to just explain and visually show you guys that a lot of different options are out here that don't require so much out of pocket. And if you recall, there are ways with these concessions or gift from a family member, whatever, that we can use to cover the closing costs to keep that out-of-pocket expense as low as possible. What is your credit score? So on the left-hand side here, free credit report resources. So I would encourage everyone, if you haven't already, just go check out what your credit score may look like. There are all kinds of resources out there. All the 3 big bureaus can give you a free credit report straight up for free once a year. Credit Karma, you can download the app, plug in your social. That's going to keep you apprised, and really it's got some good education stuff out there. And then if you have any credit cards, a lot of credit cards these days have those extra tools like credit monitoring and things of that nature, giving you a little bit of an idea of where your score may be. I will say, from a mortgage professional standpoint, these resources that I have here, they're really only directionally accurate in nature. So a mortgage credit report is going to be on a different scoring model, is what it's called. And basically the consumer stuff over here that you see on the left-hand side, it's typically going to show you a little bit higher of a credit score relative to what a mortgage credit report is going to show. And that's just based on the scoring model that we use in the industry. So if you want an actual credit report from a mortgage standpoint, feel free to contact me afterwards. We can discuss whether or not that makes sense. The other message that I have with this slide here is to, if you want to be a homeowner and this is a goal of yours, at some point you have to figure out where things stand today. Go look at your credit. Where's the score? Does anything need to happen? Are there maybe inaccuracies out there? Is that, water bill for $50 that's sitting out there whenever you moved out of the last apartment out there showing as a collection because you never got the bill and they sent it to collections and now there's some $50 fee out there that's holding your credit score down? Figure out where things stand today. Does anything need to be cleaned up? And then ultimately we can put together what I call a mortgage action plan. Is your credit score great and we're good and we can start planning for the future now? Does your credit score need a little bit of work? Do we need to go and potentially pay something off? Do we need to, what levers do we need to pull to put you in a position to be able to buy a house? And then of course, step 3 is execute. So here's the process. I'll try to keep this one as high level as I can. We've got a little bit of a graphic over here, but I'll focus on the left-hand side. I always encourage people to dive into your financials first. So the first thing that we'll do is a discovery call. We'll get to know each other. Tell me about you. Tell me about your family, your job. Like what do you want? What are your goals? What's your timeline look like? This discovery call is very important just so a professional can understand what it is you're looking for, where are things at today, and where do you want to be in the future. Those discovery calls are great, and then from there, we would review options, lifetime. No credit report is needed for this, but we can pull, at any moment, what is a rate, what's a payment gonna look like, how much do we anticipate, the cost out of pocket. So we would go through not only getting to know each other, but we would look at some options and say, hey, based on what we talked about, you're probably in this range, kind of shooting from the hip here a little bit, but this is what a payment would look like at this level. Here's what the out-of-pocket cost would look like at this level. Eventually, if you like those numbers, you think you can handle it, you kind of chew on that for a little bit, that's where we would apply. Identify where things stand, right, that I was talking about. What does the credit score actually look like? Does anything need work? Eventually, we're talking about getting you that pre-approval, figuring out what loan program might be best for you, what payment looks the best for you, what out-of-pocket option looks the best for you. We're gathering documents, and then ultimately we're presenting you with that pre-approval letter that you need to make an offer on a home. One thing that we do here at Academy Bank is after we gather all your documents, we actually send you through an underwriting process up front without a house. So we're doing a lot of the mortgage process work while you're shopping. That way, when you kind of find the one, if you will, a lot of the mortgage process is actually taken care of up front, 80%, I would say. That way, when you find the one, you can focus on some of the other things that matter, like maybe packing up your current place, maybe selling your current place. Upfront underwriting is one major key to success out there in the market today. Once you have your financials figured out, go engage with a real estate expert. I know plenty here in the Kansas City area if you ever need a referral. And then you get to shopping. This is the fun part, because once you engage with the agent, you kind of give the realtor your filters, if you will. I want to be in this area, maybe this school district. I want 3 beds, 2 baths. You would give the real estate agent, an idea of what you're looking for, and then they can get you plugged into what's called the MLS, which is basically just auto generated emails to you with the listings as soon as they hit the market. So now you're shopping. You're out on a Saturday, maybe going to visit 2-3 homes, and then you find the one. This one checks a lot of the boxes, hopefully all of the boxes. At that point, you're making an offer. This is where the negotiation process kind of kicks in. Do you want the seller to cover your closing costs? Do you want to offer full price? Do you want to try to keep it, under the amount that they're asking for the house? Try to get a deal on it. This is where the real estate agent's expertise is going to kick in, because they're familiar with the market, what houses are going for, what offer might be strong, not strong. This is where, when you make an offer, the negotiation piece comes into play. Eventually, here we are, you've landed a contract. Now the loan process starts, but remember, we've done the upfront underwriting. So while the loan process is truly starting, a lot of that work is done. Now we can focus on property-specific things. Most real estate contracts are written on about a 30-day time frame, just to give you guys a perspective of once you land that contract, you're typically about 30 days out before closing day. Closing day, everything's wrapped up. Obviously, it's a huge congratulations, huge milestone purchasing a home. But top to bottom, this is relatively what the process looks like. So this is my favorite part of the presentation. I'm about to show you a ton of information, but my goal is to boil it down to a very, very simple concept. So I want to show you guys today, I talk with folks like this about this specific stuff live time when I'm working daily. So how do you know who to do your loan with? What I'm going to show you guys is how to objectively evaluate the numbers between lender A and lender B. And then, of course, there's the intangibles that are harder to measure, but very, very important when it comes to choosing who to do your loan with. Hopefully you guys are tracking on the Space Jam reference here. I was pretty proud of that one. Love that movie. Okay, so this is the official loan estimate. This is a federal document. Every single lender out there has to use this document, and it's for transparency purposes for consumers. Now, while there is a ton going on this form, my goal is to break it down into 4 different things as the arrows. So first of all, top right corner, this is where you're going to see the loan term, 30 years typically. This is also where you're going to see what kind of interest rate you have. Is the rate fixed and not going to change? Or are you being showed an adjustable rate in which the rate may change on you later in the loan? Very important piece here. Obviously, the second one is the interest rate, most important for sure. The middle of this page where it says projected payments, this is where it's accounting for your escrow. Very common that people don't know what escrow means, what it is. Basically, when you own a home, there are property taxes that you have to pay to the county, and there are insurance. You know, the Jake from State Farm is going to need the insurance, the home covered, all that stuff. So the escrow portion of your monthly payment is for taxes and insurance. In other words, you're paying taxes and insurance on a monthly basis throughout the year. It goes into this account, this like piggy bank, and then once the taxes are due, once the insurance are due at the end of the year, each are paid automatically without any action on your side of things. It's a convenience thing is what it is. I will tell you the number one mistake that people make when they're shopping for mortgages is they look at this document, they look at the rate, and then they look at this number on the bottom where it says estimated closing costs. You probably think I'm crazy because closing costs obviously matter, but what I'm going to show you here on the second page is why this number right here is the wrong thing to look at. On the second page here, this is where it gives closing cost details, okay? So again, like the first page, there's a ton going on here. The idea that I'm trying to express to you guys today is that when you're shopping for a loan, and to truly identify from a numbers standpoint, very objectively, who to do your loan with, there's really only 3 things that you need to look at. As you can see, everything is boxed off by letter, A, B, and C on the left, E through J on the right. The number one most important consideration next to the interest rate is loan estimate, page 2, box A. Right here, this is where the cost for the rate on the first page goes. What is the lender charging me for the interest rate on the first page? In this example, there's a 1802 charge. The second one, box B, also controlled by the lender. These are basically fixed costs that the lender has to have in order to do a mortgage. And then the final thing here is lender credits. We talked about this earlier. This is a tool that we can use to cover some of your closing costs for you. Are there any credits from the lender covering some of your closing costs? Now, the point of all of this, diving into the weeds with this disclosure and all this stuff, is this. If you focus on what the lender controls, that's the interest rate and their relative costs, you can exclude from consideration all of the other closing costs. Box C doesn't matter. Box E, F, G, H doesn't matter. And I say doesn't matter lightly, but what I really mean is these are controlled by third parties. So no matter who does your mortgage, whether it's me, the credit union down the corner, your institution that you've been banking with your whole life, these other areas, these third-party costs will be the same no matter who does your mortgage. So as you're sitting out here and you're talking with lender A and lender B, now you have the secret sauce to focus in on the interest rate, what the lender is charging you, and then of course the intangibles, right? What kind of expertise is this person bringing to the table? Are they educating you on all the options, or are they pigeonholing you into one particular loan? Are they available on the weekends? Do they make you feel comfortable? Are they transparent in explaining some of these things to you? Once you evaluate from a number standpoint, then you can layer over some of those intangibles. And if you follow that recipe, that secret sauce, you're going to make the best decision for your family every time. I went out of my way to give you a couple more examples here of an intentionally ridiculous example of costs in box A. So this is a live example that I pulled, and I'm telling you right now, the customer had no idea that this was not normal. $24,000 in box A is not normal. And there are folks out there that will not go over these things with you. So if you don't take the time to shop, if you don't take the time to ask the questions, and I know all of you will now that you've seen this presentation, then you may be paying more than you really need to. Another one over here, just for comparison purposes, is a $3,900 charge. So relative to 24 grand, there's obviously quite a bit in there of a difference. So just a quick example, again, intentionally ridiculous on this one, but hopefully you guys are picking up what I'm putting down. That really concludes everything that I had for you. Hopefully you guys found this helpful in some way, shape, or form. I have a QR code right here on the screen. If you have any questions you want to, maybe get with me afterwards outside of this presentation, I'd be happy to talk to you. I also have listed some specialties and things in here that Academy Bank does, some of those loan programs, etc. So thank you guys for having me. I appreciate it a lot. You do not have to be a first-time home buyer to achieve those smaller down payment options. Being a first-time home buyer opens up some of the conventional, specifically down payment option that was listed there at 3%. That's a first-time home buyer perk. You don't have to be a first-time home buyer in order to get that 3%. There's like some extras in there from a pricing standpoint, things of that nature. But I would answer that by saying you don't have to be a first-time home buyer to take advantage of those low down payment programs. Yes, great question. Very simple answer. What that really is it's the realtor contributing some of their commissions that they're earning on the deal to help you cover closing costs. Yes, of course. So think of this as, so first of all, when you own a home, you have to pay the county taxes. Jackson County, for example, taxes are due in December every single year. So instead of getting this huge tax bill in December to where you have to pay, $3, $4, $5,000, whatever it is, all at one time, an escrow account with your mortgage helps you break that up and become part of your monthly payment that you're paying to the mortgage company every single month. So what happens is, as you make a mortgage payment in January, February, March, and so on throughout the year, the portion of your mortgage payment that is for taxes is going into what's called an escrow account. It just sits in this account all year. Every single time you're putting money in the bucket, money in the bucket. And then at the end of the year, that bucket is full enough to be able to pay Jackson County when this property tax bill comes due, because you've paid it every single month throughout the year. And again, that is handled for you automatically. Like even if you receive a tax bill from the county, you have no action because it's the mortgage company's responsibility to disperse those funds to Jackson County automatically prior, of course, to the due date. Same thing works with insurance. Correct. Yes, it is. It is a convenience thing. The way that I look at it, my personal mortgage is escrowed. It's out of sight, out of mind. Now, opinions vary as they do with everything. Some people would prefer to keep their money working for them in perhaps an investment account and just deal with that bigger tax bill at the end of the year. There's different opinions on this. I will speak just from an average standpoint. Most folks that I work with that obtain a mortgage do an escrow account because of the convenience. My mortgage jargon confused someone. Yeah, so I believe that was the second home slide where it said interest rates on second homes were awesome. So at a high level, an LLPA is in mortgage world, it means a loan level price adjuster. So the people that govern mortgages, the Fannie Mae and Freddie Mac, the agencies that govern what we do. From an occupancy standpoint, so if you're going to buy your first house, it's your primary residence, right? If you think you're buying this vacation home at the Ozarks, that is a secondary home. If you buy a property to put a tenant in there and rent it out, that's an investment property. So as you look at the difference in occupancy from primary to second home, like vacation second home, and an investment property, those are all different occupancy designations. And so what these government agencies make us do as you jump from one to the other is that they become more expensive. So what a loan level pricing adjuster is it's basically we are required to take this loan level pricing adjuster simply because you're buying a vacation home. It gets even more aggressive from a cost standpoint when you purchase an investment property. And the reason that this exists is because there are levels of risk as you look at the different occupancies, right? So like if you think of home ownership, the last thing that someone's going to do is let their primary residence default. But if if you're about to default and financials are all jacked up or whatever, like you're bound to let that investment property go first. So from a government standpoint, that's why this is intact. Now, Academy Bank being a bank, we lend our own money here. We have a little bit of discretion as to whether or not we apply those LLPAs or those loan level pricing adjusters. And we have created a loan product here specific to second or vacation homes that do not get hit with the LLPA. So a very long-winded response, hopefully bringing some clarity. But if you're looking to buy a second or a vacation home, we will not have those loan level pricing adjusters applied to your rate, ultimately making it a little bit better of a deal relative to anybody else that's doing just a conventional loan for you. That is a great question. The answer is no, unfortunately, but obviously thank you for your service as a nurse. That first responder mortgage is tied to the following occupations: police, firefighters, paramedics, nurses, EMS, anybody that works for ATF, the alcohol, tobacco, firearms, and the FBI. A lot of people keep that first home that they buy as a rental. Me and Ben were chatting before the event started, and especially those that were fortunate enough to purchase when these rates were super low, it's really hard to let go of that asset if it's financed at a 2 and 3% interest rate. So as you look to maybe level up, get a bigger space, family's growing, whatever, you're looking to buy that next home, there's no like relative disclosure that you have to sign or anything like that. It's just more of your mortgage professional understanding what the plan is. Like, you have this other house, what are you doing with it? Are you going to sell it and make some money? Are you going to keep it and like get it rented out? Like, we have to account for it in the mortgage process. But that's really the only like box that you have to check in terms of that. Hopefully that answers the question. Great question. And I would really answer this by saying I am your calculator. I am your resource. Connecting with a mortgage professional is the best thing that you can do, just simply because you don't play in the space every day. There's not like any one document that you can use to figure out whether or not you're ready, because as you apply for a mortgage, it really takes into consideration your entire financial picture, every dollar that's headed out the door every single month. And then we, as mortgage professionals, have to layer over all of just the relative guidelines for each of these loan products to figure out, okay, based on your financial situation, you would qualify for this, and this, but not that over there. So from there, then we can kind of identify, hey, you qualify for this, here's what it looks like financially, and then it becomes just more of a personal decision, personal consideration as to whether or not you feel ready to jump into that financial responsibility. So as much as I would love to say, yep, here's the document, here you go, it's much more of a fluid answer, and connecting with a mortgage professional, reviewing top to bottom your financials, figuring out what loan programs there are, and kind of going from there. Yeah, thank you for the opportunity. I've been kind of trying to go through the chat here and kind of addressing some things one off. First of all, Olive Branch, I posted my contact information in the chat. If you want to go record that, you certainly can. They're also going to push out the slideshow, probably a condensed version without like family pictures and stuff. But you'll be able to access all of this information afterwards. That also has my contact information on it. So if you want to open up any sort of conversation, please don't hesitate to reach out. I work with people that have to close in 14 days, and I have worked with people that are 12 months and beyond from doing anything. So it's really just about building that relationship with somebody that you can trust, getting the answers to your questions, and mapping out a relative mortgage action plan. One interesting question that I addressed in the chat, but I figured I'd go ahead and address it here in the group, is the idea of waiting for interest rates to drop before you think about buying a home. My take on that is this. Right now, interest rates are high in SX. It's just, they're not 3% anymore. That's just kind of the reality that we're dealing with. And that, of course, makes things more expensive from a monthly payment standpoint. I understand a lot of that stuff, but think about what will happen when the rates drop. So rates are relatively, 6.5% right now. Let's just imagine tomorrow they're 5%, right? Rates drop. What that does is it opens up a massive amount of new buyers that are now eligible, that are now comfortable into the market that still has a relative low amount of inventory. So what happens is all these people are getting off the sidelines. They're like, yep, ready to buy, let's go. What that does in the market is it drives up competition. It drives up competition and makes the home prices, skyrocket, because you've got 20 offers on the same house that just went live on Saturday. And now you're dealing with that competition as opposed to just a slightly higher mortgage payment because of the interest rate. So that question comes up all the time. I'm actually surprised I didn't think of it myself. I'm very glad they asked it. I would rather see someone refinance when the rate drops instead of going out and dealing with the competition in the market, because it can get pretty aggressive out there. So those are my final thoughts. Thank you guys very much for having me. I enjoyed nerding out a little bit with everybody today. And again, if you want to hit me up after the event, more than happy to have that conversation. That's awesome. 140 people are smarter than they were before they got in here. Do you think it's necessary to try to circle back on some of the questions that weren't addressed? This is your event. I figured I would ask. It seems like there's some things out here that we didn't have time to address. So just a thought, thinking out loud with you ladies. So anyway, something to think about. Gotcha. Well, thank you guys again for having me. Bye.